points and an 8% interest rate, usually for a 3 to 5 year term. And we do this constantly. A lot of retirees want to be able to invest this way. It's not a significantly high return on investment. At the same time, it's very low risk, and we mitigate that risk to the best of our ability. These are fully rehab properties, and they always have to be managed by our in-house management company, so that if something happens, we can protect that asset. So you're looking at monthly payments here. You got your points plus your interest. Does anybody not understand what points are? Everybody gets points, so it's 2% of the actual loan amount. So the average return is 8.39% when CDs are paying 3%. So it's an above inflationary rate return, and so you're keeping your wealth, and you're actually very, very low risk in a very low risk investment. What about our joint ventures? So our typical joint ventures, our investors are in the properties for about 65% of the market value. In year one, we have a 1-year lease, and we guarantee the renovation. So there is no repairs allowance, there is no vacancy allowance in year one only. Okay? So the typical net monthly cash flow is about $800 a month. Investor cash flow, they get 75% of the cash flow and the sales proceeds whenever we decide to sell the property. We get 25% for doing all the work. And there's a lien secured on that property so that that investor's capital is protected. You always want to secure your money against the property, always. Have that collateralized. So if you sell in year 3 at $95,000 minus the cost of the investment minus the sales costs, you're making about $23,000. The investor's split is $17,500 of that. Let's look at the returns. So $7,200 in year 1, and then in year 2 and year 3 we also have a vacancy allowance and a repairs allowance. So you're looking at $36,000 over 3 years, or an 18.7% return. Now personally, I hold it for a little bit longer than 3 years. So as you hold it longer, your return declines a little bit, but you're also going to get longer term appreciation in the market, assuming our entire global financial structure doesn't completely crash. So now, what market analysis is extremely important. Before I went to Memphis and started investing there, I analyzed tons of markets across the whole U.S. for the economics of those markets, and looking at the real estate market as well as what's happening in the overall market as far as jobs and things like that. So you want to look at the overall market indicators of that market, and we chose Memphis because of some of those things. So it's the 18th largest city and part of the 41st largest metro area, nearly 1.3 million residents. So it's not, you know, a shanty town somewhere. It's actually a growing economy. It has a diverse and growing economy where there's primary industries in distribution, manufacturing, agribusiness, and healthcare. And FedEx is there. It has their largest distribution hub in Memphis. And a lot of companies are moving to Memphis to have faster turnaround time on their product, lower shipping costs. There's a number of distribution or manufacturing companies that move there. Nissan has a plant in Tennessee. Nike actually opened a plant in Memphis. Electrolux and Mitsubishi are going to be opening manufacturing plants in Memphis, which is really interesting because a lot of the manufacturing jobs are going overseas. And one of the biggest reasons why they went there is because the government over there is pro-job. So you're actually going through and seeing the government giving tax incentives to some of these companies to bring jobs to that market, which is important for me to see, so I can see what the ideals are for the politicians in that market. It has a growing bio-research hub and is home to 4 Fortune 500 companies, and its population is expected to grow by 10% by 2020. So you see, this is kind of the overall economics, and then you want to look at the real estate specific economics as well. Aside from Elvis, which we all know everybody loves Elvis. My girlfriend loves Elvis, by the way. Memphis has one of the highest rent-to-price ratios in the nation. So if you look at a property, I'm not going to use Santa Barbara because it's absolutely ridiculous what the prices are here. But a typical property in the boonies in California might be $400,000. And you were going to rent it for $2,000 a month, so a 0.5% rent-to-price ratio. In Tennessee, you're looking at a $100,000 property that rents for $1,000 a month, so you have a 1% rent-to-price ratio, which just means you're making a higher return on your dollar due to cash flow. Okay? Now, that's not considering any appreciation or anything, just cash flow, and I'll talk about the appreciation in a second. The PMI Risk Index ranks Memphis as the 3rd least likely metro area to actually depreciate in the next 2 years. So very low risk market. A recent study by MoodysEconomy.com ranked it as the 6th most undervalued city in the U.S. It has, over the last 20 years, average annual home price appreciation of 4% a year. So you're looking at getting a higher return on your dollar due to cash flow and a slow, steady increase in the value of the properties over a period of time. It's not super volatile. Over that period of time, that past 20 years, it only had 2 quarters in which home prices declined other than 08 and 09 when everything crashed. And in 08 and 09, it went down by 3%. So it's a hugely stable market. So you're getting them under market value, so don't buy a property unless it's under market value now. You want to make sure you have that downside risk protected and have that built-in equity. This is the graph of the Memphis Housing Price Index from 1985 all the way through 2008. You can see in the 90s when it crashed, it went down a whopping 2.5%. So very stable long-term growth market where you can predict those returns, which is what you want to be doing when you're planning for your own retirement. Here is 2001 through 2011. You can see how much more volatile the California and the U.S. is compared to Memphis. Now, what do you guys think happened here in California? Anybody have an idea? Tax breaks, right? So many people were starting to buy properties that are artificially propping up the market for those tax breaks. Here's what's going on in Cali. Why don't buy here? I mean, I live in Redondo Beach. I'll live here. I love the weather, but I'm not going to buy here. You look at the unemployment rate, it's 12% plus, and that's the reported, and that's not underemployment. So, yeah, it's huge. There's a $20 billion gap in the budget right now. The California mortgage delinquency rate is up 100% year on year. 90% of those Alt-A and those option arm loans, you know, the 3- and 5-year fixed loans, are underwater. Okay? And 1/3 of them are already delinquent. Okay? So, and then in addition to that, the California tax rates are rising. Who here has heard of the use tax? Okay, a couple people in here. And so the use tax basically says that if you go buy products outside of California and don't pay California sales tax on it, they're going to charge you for it anyways because you live in California. What do you think companies are doing now? They're moving out of California. It's ridiculous. And this is very, very scary. There's approximately 850,000 properties in California that are either in delinquency or already foreclosed on. Now, that doesn't mean they're foreclosing on them already. That doesn't mean that whole 850 is being foreclosed on right now. The banks are letting them sit there for 2 years before they foreclose. And there's only 135,000 properties that are on the market. So what happens if that comes and starts to increase the inventory on the market? It's really a scary situation where if that amount of supply comes on the market, the demand better be great. Now, I heard some really cool stuff where they're starting to say that out of the country investors, they might be able to get a visa if they invest $500,000 here. That might help prop up the market a little bit. It's kind of exciting. But finally something that might make sense. I don't know. But in addition, you look at the median home price to the median income. Historically, the median home price has been 200% of the median income in California. Right now, it's 300%. And that's only because rates are low. So it's affordable right now because rates are so low. And so they're artificially propping it up by keeping rates lower right now. And we all have probably seen this chart before. This was the subprime wave that hit us. These are the option arm loans that are coming due all the way through 2012. Now, right now, they're adjusting down because the rates are lower. So people are able to afford the property. They're able to pay a lower payment. Even though they're underwater, they're still staying there. Now, the government said, hey, we're going to go ahead and keep the rates at 13% or so, low through 2013. And once that happens and those rates start to go up, what do you think these guys are going to do? When their incomes have not risen and the rates start rising on their option loans, they're going to start defaulting in even greater numbers, just like this. So start to be careful and know your timing of the market. Make sure, I'm not saying don't buy in California completely, but you better get it under market value. You better get it at like 60, 65 cents on the dollar if you're going to do that, so that you have that downside risk protected. Okay? Here's some of our renovation photos. We actually try to do a higher end job on a renovation. Who knows what a rent-ready renovation is? So, rent-ready is basically just the bare minimum. Get it ready so that a tenant can move in there. They do a tenant renovation. you want to typically do a higher end job so that that tenant takes better care of your property. I don't know if anybody here has rented a property. We're in Santa Barbara, so you guys are all probably rich, but you know, it's all right. So, but if you go into a property and there's little things wrong with it, I mean, you just, that couch hits the wall, it's okay, whatever. You know, but if it's immaculate, you want to really be, you're a little bit more aware of it. And we want to have our tenants become homeowners. So we go through and try to do a higher end job on our renovations, always wood floors and things like that if we can. You know, we go through and try to really put the right countertops on there and things like that. So do a better job on the renovations with all of the preventative maintenance done, the roof, HVAC, plumbing, electrical. Those are your big ticket items you want to make sure you have covered. Here's some actual investment examples. This one's gone already, obviously, but 34% return. So you're looking at, you know, a 3-bedroom, 1-bath, but it's 1798 square feet. Rents for $975. That's appraised for $88. We sold it to an investor for $70,400 with $14,000 down, and they're making a 34% return on their money. It's a pretty great return. And their loan is only at 64% of the value of that property, so they're not hugely leveraged. Now, you can go buy no money down deals. They're available. But what is your cash flow going to be and what's your risk going to be? You want to make sure that you have the right loan to rent ratio so that you can actually make a high enough return on your dollar. Okay? So you're looking at 11.18 if you bought this with all cash. Here's another one, 26% return, 3-bedroom, 2-bath, 1781 square feet. Rents for $1,000, it's worth $105. You're looking at a price of $84 with 16 down. You're making a 26% return. And remember, we took it into account that 26% return is after a vacancy allowance and a repairs allowance that you should be pulling out and putting in reserves, because those things happen at the same time. They don't happen on a monthly basis. It's not like we collect the money. You guys should be taking that, putting it aside, because when a tenant moves out, that's when you don't get any income, and that's when you got to make the repairs as well. Okay? You get a security deposit that covers as many of the repairs as possible, and then you can always go after the tenant for that, but you don't want to rely on that. You want to have that money put aside for reserves. So here's some additional options. So we do a lot of seller financing, typically with 50% down. Now we've seen other seller financing deals where, you know, it's a really high rate of return, or a really high interest rate. We typically charge like 6 to 8%. And we'll do 15-year fully amortized loans. Why? Because our profits are built into this, and so we're already making a great return. And so we go through and we'll help an investor get a 15-year fully amortized return so that they're actually paid off in 15 years, and they can actually use that for retirement and really cash in on that cash flow when they need it. It can be non-recourse to self-directed retirement accounts. It's great for out-of-the-country investors, and they all have to be managed by our management company. Okay, and we have outs in case, you know, there's inefficiencies or someone's really mad, or we've never had that happen, but just because we don't want to force somebody to do it. But I want to protect the asset because I'm protecting my loan. I'm personally loaning the money. So I want to make sure that, you know, someone doesn't go take the property, we sell it to somebody, they go put the money down, they go take the property and then destroy it and take every piece of thing out of it when they're not paying me or something. And I want to protect my asset. We also have notes. You typically make between 8 and 13% on your money for notes. And there's lower entry points, $30,000 to $65,000 on notes. It's always secured by a first position trust deed of trust. We're basically selling the note from these 50% down investors. And so if someone's buying it for 80% of the value and putting 50% down, you're at a really, really low loan to value. I mean, that is one of the safest investments you can